Well, the U.S. Chamber of Commerce is firing back at a decision by outgoing Securities and Exchange Commission Chairman William Donaldson to move forward with a vote on the proposed mutual fund rule. Now, last week, a federal appeals court ordered the SEC to reconsider the rule, saying that it had not taken into account the costs and alternatives.
Thank you very much for joining us. I'm Tom Donahue.
Thomas Donahue called the decision to schedule a vote outrageous and illegal.
There can be no misinterpretation of what the Commission is attempting to do here, to defy the court and all of those who believe that regulators have a duty to consider the cost and consequences of this new rule or of any rule.
Lawmakers on Capitol Hill have also asked Chairman Donaldson to back down and let the next chairman handle it. The rule would require mutual fund boards to be comprised of about 75% independent directors and have an independent chairman. Tomorrow, the commission is expected to vote 3-2 in favor of the independent chairman rule. Donahue has actually said that his group was prepared to take the SEC back to court should the rule be readopted. Well, as we've been reporting, oil prices fell from yesterday's record, but prices are up more than 40% over the past half year. And that's good news for Todd Lowenstein. He's portfolio manager of the HighMark funds. Some of the top performing oil companies are in his portfolio, which is up more than 11% for the past year. He joins us now from Los Angeles with his outlook for the oil industry. Thanks for joining us today, Todd. Let's talk a little bit about crude oil. It is lower today, just off record levels, though. Is there enough evidence to support crude at $60 a barrel, you think?
Yes, there is. We're increasingly seeing a new paradigm shift in the oil, in the energy market. It's driven largely by peaking production in the developed countries, as well as a concern in the marketplace that there's not enough spare capacity to produce at these elevated demand levels. So the supply-demand equilibrium, I think, is being set given those dynamics.
What is the outlook for refiners? I mean, are they at capacity?
Yes, U.S. refining capacity is in the high 90s right now. We are seeing bottlenecks in the system. Increasingly, at the margin, the product that is coming to market is of the sour variety, and there's not enough refining capacity to process the sour crude. So it's not translating into refined product to the end user.
Todd, we have to leave it there. We're going to come back after this break. More with Todd Lowenstein. Stay with us. We are back with Todd Lowenstein, a manager at HighMark Funds. Todd and I are talking a little bit about capacity and the refineries and how close to capacity they are, Todd, just before the break. And you were saying that we're very close at this point. That really emphasizes the also the supply-demand picture.
Most definitely. What's driving oil prices higher at the margin is this imbalance we're seeing in the supply-demand equation. It's a structural long-term problem, and we don't see it being remedied anytime soon. And we think ultimately it's going to drive prices higher for longer. And that's been our thesis for a few years now. And we expect that to play out for the foreseeable future.
Todd, what about, folks who are out there who are saying that, we really could see crude later on in the year back to around $40 a barrel or so? How does that factor into your strategy if that happens at all?
Sure. That certainly could happen. There could be a pullback in oil prices and the stocks could react. However, based on our valuation work, we see these stocks discounting $35 to $40 a barrel oil prices in their valuations currently. And if oil does pull back to 40, there will be a reaction in the short run as people rotate out of the sector, especially the hedge funds and some of the hotter money in the group now that it's moved. But we think they can still earn strong performance of earnings and cash flow growth even at $35 to $40 a barrel oil. And likely they will set to outperform the market even at that price level.
The energy group, a pretty big group, though. You have integrated oil companies. You have the refiners as well. Which do you prefer in the group?
We own a lot of names in the group. Some of the more interesting, unique names we like include Marathon and Suncor. Marathon is kind of a turnaround story. It historically has been the ugly duckling of the group, underperforming fundamentally the group. We think things have turned around there, and they have some attractive growth opportunities both in their upstream segment and downstream. In the upstream segment, we see them growing organic volume growth higher than their peer group going forward in attractive areas including Libya, Russia, and Angola. In the downstream segment, which is now about 50% of their earnings, they're close to completing an acquisition to buy out Ashland in their refining portfolio. And they're located in the attractive Midwest area, which is net short crude. So they tend to get great discounts on crude product, and that's very good for their margin structure going forward.
Let's talk a little bit about, I noticed that you also like Peabody Energy, which is a coal company. So among your energy picks, is coal sort of a safe strategy now? Is that why that's in the mix with some of the other integrated oil stocks you like?
Coal is benefiting from the rise in oil and more importantly, natural gas. Coal, as you know, it generates 50% of our electricity here in the U.S., but at the margin, natural gas sets the price and of electricity. So coal, as a low-cost producer, is benefiting in this environment. We're seeing utility stocks, inventory stocks at significant lows, and we think there's pricing pressure there. The industry is consolidated, so the number of players is a lot smaller, and we think they're acting much more rationally in terms of allocating capital. And we think the outlook is very bright for coal.
Todd Lowenstein of HighMark Funds. Thanks a lot, Todd.
Thanks for having me.
Well, the world's biggest bank will pay $25